Well, a handful of upside inflation surprises last week reminded markets that the last mile back to central bank's 2% target may indeed be the hardest, with US CPI and PPI both pointing to a bumpy disinflation continuing in the months ahead. Those data points coming in hotter than expected saw a hawkish repricing across financial markets, with treasuries selling off, led by the front end of the curve, where we saw new year-to-date highs printed on a yield basis. And that rise in yields, while allowing the dollar to gain ground for a seventh straight week, did see the S&P 500 snap what had been a 5-week winning run. A busy week awaits the financial markets this week. Earnings from Nvidia, the highlight on Wednesday afternoon after the market closed, along with the latest round of PMI surveys, minutes from the Fed and ECB's January meetings, and a busy slate of central bank speakers as well. Lots to discuss on the trade-off this week. Without further ado, let's get into the show. Well, plenty for us to discuss and digest, as always, on the show this week. And as usual, I'm joined by my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics to try and make sense of it all. And Ryan, we've got to start on a bit of a self-congratulatory note this week. We have been recipients and won an award from TradingView, their social champion, for some of the brilliant content that, everyone here at Pepperstone, Chris Weston, Blake Morrow, yourself, and I have put out over the last year or so. So thank you to everyone who voted for us to win that award, and thank you very much to you as well, mate, for joining me every week and providing the guys and girls out there with the quality insights and intel that you always do.
Yeah, thanks, mate. Always a pleasure, and congratulations to Pepperstone for scooping that award. Do we get a trophy? Is there a trophy somewhere coming in the post, or is it a certificate? But you probably want it more than anyone else, because it's probably the only thing you or your football team are going to win this year.
Oh, there you know, I knew you were going to have to lower the tone at some point. 11 goals in 2 games, mate. I can't complain at this moment in time. But usually February is the month where we choke, so I'm still on edge that's going to happen. But I'm assuming, back to our award, that some champagne is in the post. Although, given the state of the Royal Mail, we'll probably get it just in time to win the 2024 award. That seems to be the way things are going here in the UK at the moment.
Yeah, and all jokes aside, well deserved by you guys. You've been doing these shows for quite a while. Obviously, Blake and Westy doing those ones, and it's. I hope we're giving good content here. It seems we are, if you're winning awards about it, and long may that continue.
Absolutely. Long may it continue indeed. Fingers crossed. And of course, as always, if you are enjoying the content we're putting out, drop a like on the video, leave comments as well. Let us know your thoughts on the financial markets, on what we're discussing. And of course, if there's anything that you want us to discuss in the show, by all means, drop a line to us as well, and we'll try and best to get to that. But in any case, we've got plenty to discuss this week. So let's roll into Topical Thunder. Right, so I want to talk about what is probably the hottest topic of the last couple of years, and we start the show once again with it this week, and that is, of course, inflation, because it was in focus last week, and I think it was an interesting week because we've become very accustomed to inflation releases being good news over the last 6 months or so, and that wasn't necessarily quite the case last week. I think the inflation data we got, stateside last week helped to give a useful reminder to markets that although we are now well on our way back to 2% in terms of the CPI and PCE, of course, which will come out in a couple of weeks. It's a useful reminder that the road back to that level is going to have plenty of lumps and bumps in it. It's not going to be a straight line. So in terms of the CPI number, in the United States, headline CPI came down to 3.1% from a prior of 3.4. So at face value, you say, oh, that's good news. Well, actually, we were expecting that to come back down below the 3% handle on an annual basis. So that's a little bit concerning. What was more concerning was the fact that core CPI held steady at 3.9% for the second month in a row. And actually, on a month-on-month basis, core CPI rose by 0.4%, which is not only the fastest pace since June of last year, it also pushed pushes the 3-month annualized core rate back towards 3%. So it's clear that there's still plenty of price pressures that need to be squeezed out of the United States economy as we move towards this soft landing that everyone continues to expect. And I continue to expect that as well. Some of the other inflation gauges last week a little bit concerning too. Core PPI rising to 2.0%, 2% exactly from a prior 1.8. And year ahead inflation expectations per the University of Michigan survey, they rose a little bit as well to 3 from 2.9% prior. So amid all of that, perhaps no surprise that we saw a continued hawkish repricing. The 2-year Treasury rising 15 basis points on the week, as I said in the intro to the show, touching a new year-to-date high on a yield basis. We saw the OIS curve in the States now pricing in under 100 basis points worth of cuts from the Fed this year. But I guess the point I'm really struggling with here, Ryan, and hopefully you can shed some light on this, is, we've been sat here for months now, and if you turn on Bloomberg or CNBC, everyone's been saying, yeah, we're getting back to 2%, but it's not going to be a straight line to get there. Last week's data in that respect didn't really tell us anything that we didn't already know.
No, exactly. And, the PPI particularly add into that inflation picture as well. And, we mentioned last week, it's, it's June last year was when we bottomed out in inflation. And, that's now ticking over for a few months. And the market finally coming around to the fact that more in line with the Fed's estimations and their dot plots of 3 hikes, 25 pips of hikes, of 75 basis points. So, yeah, we're finally starting to really close that gap between what the market thinks and what the Fed's telling us they're going to do. That's going to probably continue, and I wouldn't be surprised if we get another hot inflation number next month, or even PCE picking up. Not only will we probably start pricing out cuts altogether, but we might get a situation where the market starts pricing in hikes as well, because we know markets like to go from one extreme to another. So, all we've heard from Fed members since is the job's not done, long way to go, and they're going to start pushing that rhetoric a bit harder as well. And they might be feeling a little hot under the collar as well, because they may have stopped their hike cycle and been touting cuts, but everyone's calendar might have to shift further into the latter part of the year before we see those, if this data keeps going the way it is.
Yeah, and I think the other point to bear in mind is not just shifting our expectations of the first cut to later in the year. I mean, both of us have said June for a while now. I'm sticking with that call. Are you still June at the moment? Yeah,
I'm still middle of the year, June, July. I'm not going to split hairs over the month, but
well, you haven't got anything to split, let's be honest. Sorry, that was really, for someone whose hair is also thinning, I shouldn't make those jokes, really.
Pot metal, but I'll give you that one.
Those in glass houses and all that. But what I was going to say more seriously is, I think it's not only, we've spent a lot of time being preoccupied with this idea of, are they going to cut in May? Are they going to cut in June? Are they going to cut in July? Does it really matter? They're going to cut at some point this year, probably around the tail end of Q2, start of Q3. I think relatively soon the conversation is actually going to move to one of how deep or how shallow is the easing cycle that we're about to go through. Is it, a kind of late 90s scenario where you get 3 rate cuts and then that's it, and you get another hike 18 months later? Because that's really not what the market's pricing in. Markets are pricing in, you get 1 cut and then you get 8 or 9 further cuts, which takes us back to about 3-ish%, which would be a roughly neutral policy setting. And I think if you see the market move from that view to one where we get a shallow easing cycle and a very short easing cycle, I think that's probably the biggest risk out there for equities and risk appetite at the minute.
Yeah, and it's one for central banks as well. They've got their neutral levels, which give or take roughly around that, called it 2.5%, 3% mark in old money. But now a few of them have been talking that rate might need to be higher, and it might be closer to 4%. So, it's going to be the level of cuts, how many cuts we do get, and how fast they come as well, because, they're not, I don't think we're going to be in a situation where they're going to cut every meeting when they do start cutting, and unless the data's suggesting they need to. But if inflation's still sticky, but, gradually coming lower, then those cuts are going to be pretty slow in coming. And that's going to push a lot of expectations out. And then, it's a long way to go. We get to the end of the year and then the market starts going, right, what's the economy like? Is it going to be really deeper cuts coming now? Or are we potentially looking at holding where we are and then maybe hiking again? So, lots of water to go under the bridge. But definitely a few hot collars going around at the moment.
Absolutely. I fully agree. Right. Well, let's move on to the UK economy. And if you mention the R word, this is your last appearance on the trade-off, I think.
What's that, relegation or something else?
What, for West Ham?
Yes, well, I can't do it without mentioning the R word, but I'm only going to technically mention the R word because, we've been talking about the UK for a while now, and it seems, perhaps that this exceptionalism has come to an abrupt halt, shall we say, because apparently things aren't looking so hot for the UK after all, if the GDP is to be believed. We've seen the services PMI positive in the last 3 months of the year, but that hasn't helped the GDP numbers for Q4. They dropped more than expected to dump the UK into a technical recession, which got Fintuit all a fire on Friday or Thursday. Excuse me. We've seen a bit of a wobbly consumer as well. We've had some good months, some poor months, and some bounces. However, there were some bright spots within the GDP numbers, mainly with business investment picking up nicely there. Now, BOE's Bailey has been quick to point out we shouldn't fuss too much over the GDP data, as Q1 is already looking a bit better. And that was seen in a strong bounce back in January's retail numbers. Now, add to that the still sticky wages and inflation numbers. And there's reasons why the pound didn't sink so much on that bad news last week. Now, in the end, cable closed the week pretty much close to where it opened, but the real economic divergence, if you like, was seen in greater detail, pound versus the euro, where we managed to push off from that 85 handle back up towards 85.70. Now, this week we start getting the next round of PMI data, so I'll be watching to see if the late year rally in activity continues here. Both services and manufacturing are expected to improve by a couple of pips, although the latter is still going to remain in contraction. And this sort of data needs to keep up the good work if we're going to continue to see a turnaround of the negative Q4 data and keep the quid on the front foot.
Yes, I'm Kyriakos. Get ready, because you're going to need to clip this up for social media. This is going to give people a heart attack out there when I say this. But Ryan, Andrew Bailey is absolutely 100% spot on with what he said there, which is something I don't think I've said since he took the job. I was going to say, pick your jaw up off the floor. GDP is a bit pointless, if we're being honest. It's a measure of economic output. It's probably the best one we've got. But the whole 2 straight quarterly contractions equals a recession thing is just quite frankly stupid. I mean, I think it's a stretch at best to say the UK is in recession when all the PMIs are pointing to a relatively solid performance. Retail spending's doing pretty well. And more importantly, you look at the labour market, we're at 3.8% unemployment. Even if you allow 30 or 40 basis points spread for the fact that the ONS can't give us an accurate number, you're still talking unemployment well under 4.5%. And I don't think that you can really say the UK is, if you use the US definition, the NBER definition, this would not be a recession. So I think the media have got whipped up into a frenzy about nothing here. And of course, you've also got to remember the data is going to be revised so many times that actually in a year or 2 years, once everyone's moved on and forgotten about this, it probably won't even be a recession anyway, because the growth figures will have ended up being revised marginally higher. So I don't think we need to get too aerated over this. If you look at those PMI numbers, we get our latest update this week, as you said, get a chart, pull up all the composite PMI gauges for developed economies. Who's top of the pile? The UK is top of the pile. And I think in terms of the market reaction, it makes complete sense. As you said, sterling ending the week pretty much where we started. The market is forward looking. The market doesn't really care that the UK was potentially maybe in a very narrow technical recession at the back end of last year. The market cares where the economy is now and what that means for BOE policy in the next 6 to 9 months.
Yeah, exactly. And it's not as if, outside of the US growth is booming the rest of Europe. We've got a flat reading of GDP. And as we've said all this year and most of last year, it's going to be a lot of the economies bumping along that zero line, maybe a bit plus, maybe a bit minus. No worries. No one's bothered. Only the press writers, as you say, got up in arms about it all.
Absolutely. Right. I'm now going to ring myself a doctor quickly, having obviously come over feeling a bit queasy, given the BOE some praise. But before I do that, let's talk about Nvidia. Now, I wouldn't usually devote a whole one of these topics to one earnings report. But I think in this case, this is certainly not your normal sort of run-of-the-mill Commodore Garden earnings report when you look at Nvidia. So in terms of the timings, we get earnings from the chip maker after the market close on Wednesday. Depending on who you look at, it's either 9:15 or 9:20 GMT. So once the US cash market is closed, although of course futures will still be trading after hours, and that's important, and I'll get onto why in a second. But the reason why I'm devoting this topic to Nvidia is because it's really been the market's darling this year. The stock is up around about 46% year to date. As we saw last year, it is again the standout performer in the so-called Magnificent Seven, although I'm starting to think we should call that the Super Six, given that Tesla is rapidly becoming a bit of a car crash. What is the other thing to bear in mind with Nvidia is that they are the third largest stock by weighting in both the S&P 500 and the NASDAQ 100. So where Nvidia's shares go after hours is going to have a significant impact on where the indices go. And by extension, it is also likely to have quite a significant spillover into other asset classes. Think about fixed income, foreign exchange, the degree to which this earnings report shifts risk sentiment is likely to cause quite a few ripples elsewhere in the world of financial markets. Now, in terms of numbers, consensus sees quarterly EPS at about $4.60, revenues at about $20.6 billion. But I think the focus for Nvidia's earnings will really be on the guidance that they give for the quarters ahead. If you think about why Nvidia's up 250, 300 odd % over the last 18 months, it's because the market is basically discounting future growth and saying the breakneck pace that revenues and sales are currently growing at, it's going to continue doing that into the future. And that's why guidance is so important. Do Nvidia say that, yes, in fact, we are going to continue this into the future, or actually things might be looking to slow down? Now, in terms of some more numbers for you, if you look at options pricing, contracts trading over the earnings release imply a move of around 10.5% in the 24 hours or so following that earnings number, which is ridiculous for any stock. It's even more ridiculous when you think that Nvidia has a $1.8 trillion market cap. I'm not going to say it's unheard of because I haven't done the numbers, but it is, a pretty punchy move nonetheless. So I think this is very, very important to keep on the radar. I know we mentioned last week the big risk for markets was the latest US CPI data. I think the big risk for markets across all asset classes this week is what the chip maker has to say in terms of Nvidia. And actually, I've got a feeling that this is probably going to set the tone in terms of the reaction to the earnings number. I think that's probably going to set the tone between now and the next PCE report out of the US, which you touched on earlier, Ryan, is likely to again come in fairly hot.
Yeah, this is going to be a bit of a market mover for equities. We don't have too much data this week coming out from US or anywhere else. So, the market's going to be looking for something to focus on, and this will be it. And it's, but it's bonkers. This could move and revalue the company, to the value of some small and medium-sized countries' GDP numbers. It's utterly amazing, and really you can only, unless you've got some skin in the game, you just got to sit back and with a bag of popcorn and watch what happens. But yeah, the forward guidance is very important, because we've been speaking about that. We've had a decent Q4 earnings season, but there's been a few issues with some of that forward guidance, seeing problems ahead, depending on whatever sector you're looking at, whether it's electric vehicles, as you mentioned, with Tesla or anywhere else. So, yeah, the forward-looking statement is going to be very important. But this is going to move whichever way, whatever happens, it's going to be a mover, whether they come out in line, a slight miss, a slight beat, big miss. And that's going to send ripples through the broad markets themselves. So if you are trading, you may not be interested in the stock on an individual basis, but look at it from what its knock-on effect can be in indices, even in bonds and FX. The whole swathe of markets could be affected by this one.
Absolutely agree. And as always, with any of these big risk events. We call them risk events for a reason, because they are a risk to be managed. I think capital preservation is the first priority, as it always is in this game, and then look for the opportunity. And as Ryan said, it's something that I think is going to impact all markets, not just single stocks and the equity in question, of course. But I'm sure that will give us plenty to digest next week. I feel like you're doing this to wind me up, but you want to talk about politics here in the UK. I mean, who on earth has got the desire to talk about that?
Well, me, of course, because it is something that, I need you to fill a slot, so I might as well talk about it. But anyway, it is important. And we did have a bit of an event last week as well on the election front. I just thought it might be apt to keep viewers up to date, particularly viewers who are not from the UK and want to know what's going on, because you might be trading the pound, the FTSE, other UK assets. So you need to know what's going on the political scene. So we still haven't got a date for this election, but it seems that November has been, ruled out so as not to clash with the US elections. There has been talk about an October date, but also that PM Sunak may leave things as late as possible in the hopes that the economy in the UK improves to, give him some sort of positive platform to spin his campaign from. However, it's not looking good at the moment. The main opposition Labour Party absolutely cleaned up in 2 by-elections that were held last week, which leaves the governing Conservatives with the longest losing streak in these by-elections since the 60s. Sunak is also potentially set to see the biggest amount of MPs in his party's history standing down ahead of the next general election. So as things stand now, the big shock will really be if Sunak wins the election. And so we should probably be preparing for a changing government when that election happens. So what does that mean for trading the pound and all things UK? Well, firstly, the market likes political stability. So if Labour win, they take a strong majority, the market will be calmed by that. Then it will boil down to what their policies are, particular economic policy. Now, to date, Labour have had a pretty positive response from some business leaders they've been speaking to about their plans. They've also dismissed or adjusted some of their harsh-sounding policies that they've touted previously. It's like most challenging parties. There's a lot of grandstanding of big changes when they oppose government plans. But when it comes to the election crunch, a lot of those grand plans get watered down to something more towards the middle of the political spectrum. So for now, I don't see any huge risk for the pound, but we do have a long way to go yet. But at the moment, it's looking like Labour is going to walk this one.
Yes, it does. Already, it's the 19th of February. We are, 9, 10, maybe even 11 months from an election, and I'm already bored of it. But at the moment, though, in all seriousness, I'm not entirely convinced this is going to have a huge market impact. I know it's sort of too early to, make any grand proclamations of that ilk. We don't know what the manifestos are going to be. We don't know what the policies are going to be, all the rest of it. But it just feels like it's not an election like we had in 2019, where it was, Brexit related and all the rest of it. This one feels like it's going to be much more domestically focused, and barring some tinkering around the edges, I'm not sure either is going to change, particularly economic policy too significantly. But of course, only time will tell, I suppose. And it's going to take up plenty of column inches, and regrettably, I'm sure it's going to take up plenty of minutes on this show as well.
Yeah, well, we talk about markets, how they trade, what's ahead and what's coming. And, the election is one of those things, whether we like it or not, the market's potentially going to trade it at some point. And, we could get some big headlines one way or another, particularly around when they finally announce what the date will be. So, yeah, we won't talk about it every week, obviously, or Michael probably
goodness for that.
Discuss. But, when something happens, I'm happy to bring it to the viewers' attention.
Good man. And that's why we have you here every week, isn't it? And that promise not to talk about politics, of course. Right, let's move on to some charts. So the first thing I want to have a look at is the yen this week. It feels like roles reverse. Normally Ryan chats about the yen, I chat about Wall Street. We're switching it up a little bit this week. The reason why I want to look at dollar yen, well, not dollar yen, but the yen more broadly, is because dollar yen traded up through the 150 handle last week. We have seen a bit of a pullback on Friday and in early trade this week, but the market is, of course, thinner than usual today owing to President's Day over in the United States, so I wouldn't read particularly much into that. What's been interesting, though, is that as we've moved through that 150 handle in dollar yen, predictably we've heard a load of chatter once more about potential intervention from the Ministry of Finance. So what I thought I would do is go back into the archives, and this is a chart that I made, and I think I showed it on the trade-off at some point last year, of a handful of metrics that the MOF might be watching when they decide or when they make the decision whether or not to step into the market. Now, I stress the word might because outside of the Ministry of Finance and the Bank of Japan, of course, no one really knows exactly what these guys are looking at. But it seems most likely that they're going to be looking at how the yen's trading against its major peers and various measures of yen volatility to try and get a feel for whether they should be stepping in or not. And I think the important takeaway from how they've intervened in the market in the past is that the focus hasn't so much been on the level that the yen has reached or weakened to, but it's been much more on the speed at which the yen has got to that level. Now, rather helpfully, Kyriakos has chopped the top of this chart off, but what it would show, if it hadn't been chopped off, is the fact that the yen has weakened for 7 weeks in a row, but it hasn't weakened by particularly much. We've, sort of 5-6 big figures, not particularly big of a move. And if you then look at implied volatility, there really hasn't been any significant pickup in implied vol across a 1 week or a 1 month tenor. And you can see there by the green and red dotted lines, we are still quite some way off the peaks that we saw when the MOF last stepped into the market. And I think the bigger factor that you need to bear in mind is that actually the move that we're seeing, the move lower that we're seeing in the yen, is bang in line with the fundamentals in the market at the moment. The expectations for a prolonged BOJ tightening cycle are being pushed back. Treasury yields ratcheting higher as the US economy continues to outperform and after those inflation prints last week. So what I'm saying here, putting all of this together, is I think there could still be more downside in store for the yen. And as long as it takes place in a relatively controlled manner, I think authorities are going to remain on the sidelines for now.
Yeah, it was very interesting last week getting those comments out because we follow those a lot. What the jawboning comes from the Ministry of Finance, from Suzuki, from Kanda, the top currency guy there. And the thing that struck me about those comments is that in terms of jawboning bingo, everything was in there. Usually it's a gradual build up of rhetoric. We talk about markets moving in line with the fundamentals opposed to rapid moves. But they threw everything. There was speculative, there was fundamentals, rapid moves, and it's sort of gone from 0 to 60 in 3 seconds, whereas usually it's a bit of a build up. So that struck me first and foremost about that verbal intervention. Secondly, one thing they do look at is the trade weighted yen. The Bank of Japan produce a number out each day. That's been hovering at pretty low levels. For the last few months. So that needs to be taken into context as well. They look at a broad range for the yen. But in regards to the speed, Kanda had a fair point last week. He said, when the yen's moved 10 big figures in the period of, 6-7 weeks, that's something that they need to take note of. We started the year down at 140 and here we are at 150. So it has been a significant move. The fact they've come out all of a sudden, as I said, with such strength in jawboning, and it had zero effect on the yen level when they did, gets me thinking that they are now particularly looking at a level up here. 152 has been the big level that we couldn't break. That's when prior jawboning and intervention has stepped in. So I think they're looking at that now more as a level. They won't admit they've got a level, but that's where I think they're beginning to, let's say, put up some defences. In case things continue upwards. But a bit of a strange one. Not out the woods yet, obviously. All bets are off when the BOJ finally move, if they move. I think from here, the big risk is if the boxes don't get ticked for the BOJ to end easing, if they don't get inflation in the right place, if they don't get the right level of wage increases, if the economy is softening and inflation's pulling back, forcing them to delay ending easing. 152 is going to be the least of their problems. We're probably going to be in the 160s not long after.
Yes, very quickly indeed, I would imagine. Right, let's move on. The S&P.
Yeah, I wanted to keep this one going from last week because I think there's some.
You got rid of your little drawings from last week.
Sorry,
I said you got rid of your little crayon sketches from last week.
I put new ones on. Look at that! I've updated and put new ones on just for you, Michael. I'm going to start sending you a key to my charts soon because you seem to be struggling with them. But yeah, I think there's some important lessons here. Last week we were at that first vertical yellow line, so we hadn't had the big dip from the CPI numbers. And I said 4 things back then. One, that the price action looked like patience for dips is wearing thin and forcing people to chase. And what happened? Well, they chased it all the way to the 50-51 high. I then said that when it turns, the chasers will be the first to bail, and which should lead to a bigger drop. And thus the CPI was the trigger for a mini dump all the way down to 49.20s as those late chasers got taken out. Thirdly, I said, if you want to be long, wait for the flush to bring out the patient dip buyers. Well, out they came at 49.20s and took it pretty much all the way back to the highs. And lastly, I said that shorts will need to see proper evidence that a top is in. Well, the proper evidence is that the high on Friday, that's the second high, pulled up short with the first high at 51. I also said that I wanted to see a high that lasted longer than 2 or 3 days, which we've now potentially got with a failure to take out that first high. So that's 2 highs now over the period of a week. And what that's done is just solidified the high somewhat. Now, all this does is give traders more solid levels to base trade on than they had previously, particularly over the last couple of weeks, which means that trading risk is easier to define and there's no need to go chasing or guessing where tops or bottoms are going to come in. So from here, shorts have something more substantial to lean on, and longs know what needs to break to see further upside. So if you are long, you need to be careful if we don't break those highs. I'm one of those longs, and I'm going to be watching that very carefully. If we don't manage to break those highs on subsequent tests, I'm going to think about taking more of my position on. And conversely, if you were waiting to try and pick a top, now you've got 2 highs to lean against. You know where your risk is. Break those highs, and we're off and running again.
Indeed. Buy the dip.
not BTFD. You're going for the polite version.
I get told off if I went for the impolite version. It is a family-friendly show, Ryan. But yeah, buy the dip. Nvidia earnings might be a bump in the road, but buy it. That's the way I see it. I see very, very little reason to be anything other than bullish risk on anything other than the shortest of short-term timeframes at the moment. I think, particularly from a policy point of view, the policy backdrop is only going to become more supportive as we move through the remainder of the year, both in terms of a rates point of view. Obviously we're going to get rate cuts, but also in terms of a liquidity point of view as well. The Fed are going to bring QT to an end at some point. They're going to discuss that more formally at the March meeting. And if we were to see any sort of financial stability issues prop up, well, central banks have shown that they're going to come in with targeted liquidity in size in very rapid fashion as soon as that pops up. So, if you want to be bearish and want to be short over a prolonged period of time, you're fighting some very, very powerful forces from the policy point of view. You're also fighting an economy, particularly in the US, that is incredibly strong and continuing to outperform compared to expectations. Path of least resistance still leads us higher, in my view.
Yeah, I think so. And there's always two sides to a market. So, there's going to be enough for everybody, longs or shorts, as long as you know the context of the moves. I think here right now, Nvidia aside later on this week, this 5K level is a bit of a pivot level. It got taken out over the CPI, a big risk event. So, your levels aren't going to stand up to that. But if we're holding above that 5K after Nvidia's finished, then I think that's probably the time we're going to go on to make new highs.
Absolutely. Right, let's move on to the dollar. I'm going to keep this relatively short and sweet because not only am I bullish equities, but I'm still bullish on the greenback as well. Last week's price action was interesting. If you look at it through a technical lens, we obviously had that rally up to the 105 handle in the aftermath of the CPI print. But then the dollar came off the boil just a little bit. I think that psychological level was used by quite a few to take some risk off the table, lock in some profits. The dollar at that point would have been up just over 4% on the year. So that's perhaps not surprising. But the dollar did then notch 3 straight daily declines for the first time in a couple of weeks, which I think is noteworthy, if nothing else. But the important fact from a technical standpoint is that the losses we saw were arrested by the 100-day moving average, which comes in around 104.20. And of course, that also meant that price remained above both the 104 figure and the 50% retracement of the fall that we saw last year, which comes in just below that 104 figure. So when you couple that relatively supportive technical backdrop with the fact that the US economy continuing to perform well, hawkish repricing of Fed policy expectations, and the fact that there's really nothing else in G10 worth buying at the moment, I remain bullish on the buck and will do so as long as we are above that 104 figure. In fact, probably above the 200-day moving average. And I would expect us to get back towards that 105 and maybe even above that 105 level in relatively short order.
Yeah, I think my biggest take from last week, and again, we mentioned this last week, was that when you get these big risk event weeks, big data points, speakers, central banks, whatever, you need to see where you finish at the end of the week. Has something changed in the market? And for me, nothing's changed. What has perhaps changed is obviously the market's got less dovish about the Fed. We've seen sticky inflation, sticky price data points. So that's been supportive of the dollar and will remain so moving forward. So, yeah, I'm not a big fan of the Dixie, as you know, but, it's more a measure of what's going on in FX markets in the basket. But, the dollar saw a few little slumps on different data. But I think overall, the market is leaning towards what happens in inflation more than what happens in, say, retail sales or any of the other sort of sector parts of the economy. So if that's remaining strong and we're getting this sticky inflation, then that's going to keep the dollar on the front foot.
Yeah, very much so. I'm not the biggest fan of the dollar index either. Bloomberg's dollar index is much more evenly weighted. The only reason, well, there's 2 reasons why I'm bringing the dollar index chart here. One is just to wind you up. And the second is, I'll be honest, the second more serious reason is because it's actually a tradable product. You have futures trading and CFDs and spread bets trading on the dollar index. You don't have those derivatives trading on the Bloomberg Dixie or the Wall Street Journal's index or whatever. So that is the reason, the serious reason why I'm using it as a rather rough and ready gauge of the greenback strength. In any case, why don't we move on to the bond market?
Yeah, I'm going to talk about a proper market here, one that you can really trade properly, not with some made-up fancy futures market.
And actually, sorry, just before you talk about that market, hot off the press, one you can now trade with Pepperstone as well.
Oh, yes. That's some news. Ooh.
It is news. There you go. We're bringing you analysis, commentary, and news on the trade-off now as well. Yes, whole suite of treasuries and also gilts and Schatz and Bund as well.
Oh, I have to have a little butcher's at that. And
there we go. That's got you interested, hasn't it, mate?
Oh, yeah, it has now. I'll rub my hands about that. I'll see what your spreads are like first. But I'm sure they're going to be competitive.
Razor sharp.
Yeah. But I'm going to talk about US 10-year bonds, US Treasuries, because this is where inflation really matters. Now, yields finally jumped in the 10s through this 420 level that we've been watching for quite some time, been a bit of a ceiling. That happened after the CPI data last week. And we've held above even as some of the other data numbers have faltered, like retail sales. This is an important move as it shows, as I said, that inflation is the main game in town regarding the Fed. It also means that finally the market has narrowed that gap between how much it thinks that the Fed is going to cut versus what the Fed have told us they're going to do. As Michael noted earlier, we're now roughly about 85, 90 pips of cuts versus the Fed's 75 pips. So from here, it's more a question of whether the market starts taking this further and pricing, as I said, maybe under the 75 pips expected from the Fed. So getting a bit more hawkish rather than over it. I think that's a very, very low risk, but it's a risk nonetheless. So while tens broke the 420 level, it ran into trouble not far after at 430. My next main level was around 440, 450. And what I'm looking for is whether we set up a new range between those high numbers and this 420 level. If we do that, we're likely to see the dollar remain supportive. And that's when Michael's DXY might be clearing out the 105s if we're testing the high side of the range. So if you want to know exactly where the market is pricing the Fed, you need to look at yields. Tens, as we've spoken about before, are a good basis for most traders to look at. But also keep an eye on those 2 years as well, because they're right back into where the Fed 3 cuts would be at that level. So it's important to keep your eye on yields for what's going on with interest rates.
Yes, absolutely. I love how you slag off the dollar index and then you go and cite it anyway, But yes, I think bonds are going to be a buy at some point, and I appreciate that is the vaguest prediction in the world. But but it needs growth to roll over first before I have more conviction to actually start saying, that you should be buying the long end. So actually, I fully agree with the thesis you've laid out there. It will be interesting if we do move into a range on a yield basis that is substantially higher than where we are now. And of course, we're only, a month away from all the fun of the fairer, the next FOMC and their latest dot plot. So although they're saying 75 basis points of cuts per the December dots, be interesting to see whether those expectations have changed at all when we hear from the Fed in March. And of course, we've got a whole host of Fed speakers this week as well, who might move the needle here. But of course, treasuries need to be on every trader's radar, no matter what they're trading across the board. Right, let's move on to our plays of the day. Right, I'm going over to Asia this week, and I believe I've mentioned and brought up this chart on the show before, but I'm going to do it again anyway. And the reason why I'm going to do it is because momentum is still moving in favour of my prior position, which is to be long Japan and short China. It seemed like sentiment had improved in China before the Lunar New Year holiday. We discussed this on the show last week with another round of stimulus and market stability measures, including the head of the securities regulator losing his job. But ultimately, all of that's going to be useless unless and until the Chinese authorities fix the economy and this debt deflation doom loop that seems to be getting worse and worse. And fixing that seems to be quite a long way off at the moment. This is all really tinkering around the edges and not tackling the issue at hand. In contrast, Japan, as we've covered at some length before, seems like a much better bet for Asia equity exposure. The Nikkei is just off an all-time high that it set around about 35 years ago. Of course, strength breeds strength, as we've seen on Wall Street over the last 4 or 5 weeks. And of course, the other thing you've got to remember with Japan is all of the various corporate reforms that are going on to try and encourage firms to use cash more efficiently and increase returns to shareholders. You've got a new ISA program as well to try and encourage more retail interest in the market. So the long Japan, short China / short Hong Kong trade that I had on before is one that I see no reason to back away from anytime soon. Ryan, it looks like you're also talking about Japan this week.
Yeah, I'm on similar tangent to you there. This one has a bit of China influence as well. It's Aussie yen for me. We're up testing some multi-year highs. It's been tested a few times since 2022, but also a historical level going all the way back to 2007 if you look far, far left. So I'm looking at this one for a short up into those highs on the fact that there's decent looking resistance there, and from the point of view that I too don't think that China's out of the woods yet. Despite the support work being done by the government, which should weigh on the Aussie dollar somewhat too. And then we obviously have the BOJ debate looming large also. So I feel there's a good confluence of the fundamentals and technicals leaning to the bearish side of this one. So I'm looking for a short into those highs, but I'll be looking for a stop over the 99 big figure just to try and stay out of the way of any stop running shenanigans immediately through those prior highs. So yeah, short side for me, and see if the fundamentals and the technicals align.
Good stuff. Well, I guess that's both of us off of Beijing's Christmas card list, but hey-ho. Right, well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forexflow Live and Forex Analytics for joining me. Thank you to our producer, Kyriakos, as well, for bringing this together as brilliantly as he always does. I hope you've enjoyed the show. If you have, please do drop a like on the video. Let us know what you're thinking about the markets at the moment, and if there's anything you would like us to discuss, please drop that in a comment, and we will get to you at some point during the week. And of course, we'll be back with another episode of The Trade-Off this time next week. Thanks as always for watching, and goodbye for now.